Hello and Merry Christmas to you and your family. As this year draws to a close, I welcome you to our two-part year-end special on Investor's Guide. We begin this week by re-looking at the 7 portfolios that have been designed on this show that we've been managing now for 4.5 years. We have the numbers to show you how these portfolios have been performing and to prove that regular, simple and patient investment actually does pay off in any market. Next week, in the second half of our year-enders, we'll pick the top mutual funds to invest in the new year. And of course, none of that would be possible without Dhirendra Kumar. Let me bring him into the show. Dhirendra, thank you so much for joining us and Merry Christmas to you.
And Merry Christmas to you, Faye.
Well, we look at these 7 portfolios now, and are you pleased in any way with what you're seeing in terms of returns across the 7 portfolios?
Looking at these returns, there is nothing in these returns when you have single-digit return, though positive. On a relative basis, technically, we can say that we have reason to be pleased with it. It certainly is a validation of all the principles that we follow. But looking at these returns in isolation, assuming that I had no idea of the market, and when I look at 9% annualized return, I think, there is nothing exciting about these numbers. At the same time, there is nothing disappointing when looking at it from a relative standpoint. I think the crucial thing to note here will be that one would have accumulated this much of savings into something meaningful. So, the recurring savings element in these portfolios, I think that is also a crucial aspect.
All right, so before I start talking about these portfolios, I want you to jot down our email ID that's at the bottom of your screen right now. If you have any questions about anything you hear on the show, feel free to write to us. All right, now it's down to business. I'm going to start with our first portfolio. A quick recap, this is our aggressive portfolio. It was designed for someone as young as 25, which means the assumption is you're going to invest regularly right through your working years and you have at least 30 years on your hands to make these investments. Now, we started this portfolio 4.5 years ago in June 2009, and we've hypothetically been investing 10,000 rupees every month in this portfolio. It's totally given us a return of 9.5% almost over the last 4.5 years. I'm going to give you a recap of the funds in this portfolio as Dhirendra recommended: the DSP BlackRock Short Term, IDFC Premier Equity Plan A, Quantum Long Term Equity, SBI Emerging Business, UTI Opportunities. Now, we've invested 5.5 lakh rupees and we made a profit of about 1,15,000 rupees on this portfolio so far. Like we were talking about, Dhirendra, now on its own it might not seem like a great profit, but if we look at the market over the last 4 years, the ups and downs and the heartache that it's caused investors, this is an impressive aggressive portfolio.
Yes, but eventually, when you look at the pure arithmetic of it, it is 9% annualized return. I think the consolation one can derive is that this is an aggressive portfolio. It has a sizable allocation to mid and small cap stocks. It also has, 10% allocation to fixed income all the time. So in one sense, our most aggressive bet is also following a set of principles. And it is built on 5 funds with a fairly well articulated mandate. So reason to be happy. At the same time, single digit return, much more to be expected. And I think these portfolios will really come to deliver things in life, because when I look at inflation, what it has been over the last 4 or 5 years, we have reason to be very disappointed with these returns. 9% return from after assuming so much of risk. But yes, this has also been the most troublesome time for the market. And I think one upturn, this portfolio has not, on any of our portfolio over the last 4.5 years, hasn't seen any market upturn.
All right, so we're waiting for a market upturn, and this will teach us basically to be patient with our investments. Remember, with an aggressive portfolio like this one, we haven't lost any money and we have made a profit. I'm going to give you a recap of that aggressive portfolio. There's the DSP BlackRock Short Term Fund, the IDFC Premier Equity, Quantum Long Term Equity, SBI Magnum Emerging Business and UTI Opportunities. Let's move on to our next portfolio. This is our growth portfolio designed for someone who's 35 years old. It steps back ever so slightly on the aggression, but it's still meant to give you strong returns. These are the funds in this portfolio: the FT India Dynamic PE Ratio, the HDFC Midcap Opportunities, The ICICI Prudential Discovery, the Quantum Long-Term Equity, UTI Dividend Yield. Dhirendra, would you like to make any changes in this portfolio? It has given us a return of nearly 9%, but do you think there are some funds there that you'd like to switch over?
Yes, I would like to simplify this portfolio a little bit, and also based on the kind of performance that has been derived from other kind of funds, and ensuring our basic principle that reduce the number and ensure the diversity of a style across also the approach of various fund managers. And this being a growth portfolio, all that we ensure is that it does not get into the very venturesome component of it should not have a large component of small and mid caps. At the same time, 20% allocation to fixed income, that is being derived in a fairly dynamic way with the Franklin Templeton Dynamic P ratio fund. And it has worked out very nicely in all the allocation where we have this flexible component, because the 20% allocation, this is the long-term portfolio. At the same time, we want this allocation to fixed income at least in the region of not less than 15-17% and not go exceeding 25%, and that is something which is managed very nicely with this fund. So the fixed income or the stability, the component which derives stability in this portfolio is achieved with this fund. I would like to substitute the ICICI Prudential Dynamic Fund, the Discovery Fund with the ICICI Prudential Dynamic Fund. I find this fund to be a little more conservative, and tactically this fund reorients compared to the Discovery Fund, which right now is heavily, it's a value fund. It's heavily into small and mid caps, and sometimes it can be a test of patience. So that fund is a compromise on stability which can be derived from this dynamic fund. Likewise, I would like to have Templeton India Equity Income Fund as part of this portfolio.
All right, so that's our growth portfolio. Remember, it's given us 9.29% returns over the last 4.5 years. I'm going to give you a recap of the portfolio as it stands. FT India Dynamic P Ratio Fund, the ICICI Prudential Dynamic Fund, Quantum Long-Term Equity, the Templeton India Equity Income, and UTI Equity. We have another portfolio I'd like to look at in this segment, and that is our international portfolio. It was started on the 1st of July 2011, which means that it's about a year and a half old, but it's given us returns of 21.5% since then. And these are the funds in that portfolio: the Birla Sun Life International Fund, the Motilal Oswal Most Shares Nasdaq 100, the Principal Global Opportunities, and Sundaram Global Advantage. Now, we invested about 3.8 lakh rupees in this fund, in this portfolio a year and a half ago. It's currently at 5.4 lakh rupees. So we've made that much of a profit in a year and a half. Dhirendra, that's really impressive. But it is an aggressive investment, isn't it?
It might look aggressive, but it is not, because your money is so beautifully, is invested across the world. And that was the goal with this portfolio: go beyond India. And that has come in handy, that very approach that one should diversify, and true diversification or should also mean investing beyond our home market. So at least have a part of your money which is not entirely dependent on India or Indian performance. So from that standpoint, it has come to life, and it has been a big beneficiary of the rupee depreciation, which I think is not a replicable instance. It's not an event which will occur at a defined periodicity. Yes, over a period of time, rupee will depreciate, given the interest rate differential we have in many economies and India. But I don't think it will repeat very often. So this is a one-time benefit that has accrued to this portfolio. But otherwise, I feel that I'll be very happy with just 2/3 of these returns being achieved with such a portfolio.
All right, so we had a lucky streak there with our international portfolio, but we're going to continue to calmly invest 10,000 rupees a month in this portfolio. A quick recap of the funds in our international portfolio: the Birla Sun Life International Equity Plan, Motilal Oswal's Most Shares Nasdaq 100, that's an ETF, Principal Global Opportunities, and Sundaram Global Advantage. Dhirendra, they're not making any changes in our international portfolio. Time for a very quick break. When we come back, we'll discuss a portfolio designed for a 45-year-old and a 55-year-old. Stay tuned. Welcome back. You're watching Investors Guide on ET Now. This is our year-ender Christmas special. So Merry Christmas to those of you who just tuned in. Kumar is with us in our Delhi studio. I must confess, of all the portfolios we have on this show, this one is my personal favorite because we designed it for someone who's 45 years old, but it tends to suit the needs of so many other investors, and it's given us a total return of 8.77%. This is our stable growth portfolio with only 4 balanced funds, which means it's so easy to manage. I'm going to go over that list. The Canara Robeco Balance, the HDFC Prudence, ICICI Prudential Balanced Advantage, and Reliance Regular Savings Balanced. The interesting thing about this portfolio is that even though it's not aggressive, the returns are so close to our aggressive portfolios. Do you find that impressive, or does it make you a little nervous?
No, I'm very impressed with this portfolio. And in fact, 4.5, 5 years back, I did not have as much belief in or conviction in this structure. But now I find that, this is very impressive. The key benefit which is derived in this fund is you have 30% allocation to fixed income, and you have this periodic rebalancing which is happening. Looking at the simplicity, the scale of diversification, the skill which is derived, I think this is wonderful, and the returns are very impressive. I'll be very happy if I'm able to derive 1.5 times more than the long-term return derived from equity. At the same time, it helps me well on the downside. For example, HDFC Prudence, for its the complexion of the equity portfolio is something which can be very scary for somebody who is getting started. So one has to be a little careful on that front, but as a portfolio, the stable growth portfolio has been able to withstand all kind of turbulence in the last 4.5 years very nicely.
All right, our stable growth portfolio is a stellar portfolio that's done so well, 8.77% returns on a portfolio with just 4 balanced funds. I'm going to give you a recap of those names. There's the Canara Robeco Balanced, HDFC Prudence, ICICI Prudential Balanced Advantage, and Reliance Regular Savings. All right, let's move on to our conservative portfolio. Now, this portfolio has given us returns of about 7% over the last 4.5 years. This was designed for someone who's very close to retirement with about 4 or 5 years to go, who'd want to basically keep the capital safe. I'm going to give you a list of funds in this portfolio: the FT India Dynamic PE Ratio, the HDFC MIP Long Term, and the Reliance MIP. Dhirendra, we invested so far 5.5 lakh rupees in this portfolio. It's currently at 6.5 lakh rupees. So is that enough of a profit to justify what we were trying to do with this portfolio? Has that really managed to play out the way you wanted it to?
No, I would have been happier because one is assuming far lesser risk, and it just has about 35 to 40% allocation to equity. So this portfolio should not have hurt, and the 60% into fixed income should have yielded much more. So in that sense, this portfolio, despite its reasonable return, is a little disappointing. And I think we can really trace the reason for that disappointment. These funds are very expensive. The higher expenses of the 2 MIPs that we have. These funds are 85% fixed income, 15% into equity, and their expenses are as much like an equity fund, something like 2.5%, 3%. So we have to wait for the market turnaround for something good to happen. Otherwise, by next year we will take a call. If expenses don't come down on these MIPs, which means that MIP should not be part of any individual investor's portfolio. All
right, so we're disappointed with the expenses on an MIP. So basically, if you also have an MIP in your portfolio, you need to be asking yourself if you want to pay about 2.5% for someone to manage something that's largely debt. I'm going to give you a recap of these of the funds in this portfolio, and remember, we're going to be watching how it does over the next 6 months or so to decide whether we want to switch over those MIPs into something else. We have the FT India Dynamic PE Ratio, the HDFC MIP Long Term, and the Reliance MIP that forms our conservative portfolio. We're going to take another quick break here. Coming up after that break, we'll talk about our income growth portfolio that was designed for someone who's already retired, and our interesting experiment of picking low-cost funds and finding out if that increases your return. That's coming back on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in 80 now. Thank you for staying with us and Merry Christmas to those of you who just tuned in. We're looking at portfolios we designed on this show 4.5 years ago, which we've been tracking on a regular basis. This portfolio is our income growth portfolio. It was designed for someone who's already retired. The assumption here is that you're going to take advantage of the Senior Citizen Savings Scheme and use the remaining money to beat inflation through this portfolio. It's given us a return of nearly 9% in 4.5 years. These are the funds we have in it: the Franklin India Dynamic P ratio, HDFC MIP, Reliance MIP and UTI balanced. Dhirendra, has this managed to beat inflation? Is this the portfolio you had intended to design when you started off?
The MIPs, they do concern me on account of their charges, but the performance is not derived from the balance fund. If you look at what we have done is we have kept a very limited withdrawal rate. Investment of rupees 10 lakh rupees split over 4 funds, which is 2.5 lakh rupees each, and withdrawing only 2% on a quarterly basis, which effectively means 8%, not compound interest, but 8% withdrawal rate on a quarterly basis. In this kind of situation, when one is consuming money, still one is able to derive a nearly 9% return is quite impressive. But we run the risk of eating a part of our capital and not being able to beat inflation if the market continues the way it has been for the last 5 years.
Well, Dhirendra, for someone who's retired or near close to retirement, would you rather than they use our stable growth portfolio instead of either the income or the conservative portfolio?
No, because if you're looking at a supplementary income from your portfolio, of course this is a portfolio which should not be the part of your defined income. If you have your retirement accumulation and if you depend on such investment for regular income, this is not the kind of portfolio you should have. That money should be into guaranteed fixed income portfolio, at least a good part of it. And this I would say that is a supplementary income portfolio that you need some money periodically for to supplement your income beyond your monthly income. This can serve the purpose. I don't think our stable growth portfolio or a growth portfolio should be that is not assumed as something from which you will derive income.
All right, our income growth portfolio is on your screen right now. I'm going to give you a recap of the funds we have in it: the FT India Dynamic P ratio, the HDFC MIP long term and the Reliance MIP, along with UTI balanced, which is the only balanced fund in this portfolio. The idea behind this portfolio was for someone who's retired to put most of their money into the Senior Citizen Savings Scheme and then use this portfolio to beat inflation and to give them a regular income of about once a quarter. Let's move on to our last portfolio, and this is our low-cost portfolio. It was designed in 2010. The idea behind this portfolio is to use funds that have very low charges. The cost on the average in this portfolio is 0.85%. It's given us a total return of nearly 6%. I'm going to give you the funds in this portfolio: the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. Those are the two funds we've used. Dhirendra, has this actually proven your hypothesis that lower cost means higher returns?
No, not at all. In fact, lower cost and lower return. And this is disappointing in the sense that if you look at Nifty, and that is 70% of this portfolio, and Nifty has been among the best performing funds, so to say, because large caps have ruled over the last 1 year. So it should have done well, much better than what it has done. But not to say that this is also an accumulation portfolio. So one is doing a SIP of 10,000 rupee in these two funds, 70% into Nifty and 30% into Junior Nifty. Lower cost is not translating into something meaningful right now, but I think it is too early a period to evaluate in terms of cost and benefit. I think it's a matter of, on one front, I'm extremely comfortable that it certainly is lower cost. It is not a compromise on diversification. Once money is spread over about 100 stocks by investing in these two funds, you are not into unknown names. So these 100 stocks are something which will be where you are unlikely to face the kind of consequences you do when you invest in a small cap fund or a micro cap fund or a incompetent fund manager who spreads your money across something which you don't know. So it is a proven portfolio. Yes, the cost and benefit are not visible right now.
All right, the cost and benefits are not visible right now, but we're going to continue investing in this portfolio to see what a difference it makes in the long term to pick funds that are low cost. These are the two funds we have in our portfolio, the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. Those two funds make up this portfolio. That brings us to the end of this show. Dhirendra, thank you so much for joining us. And of course, we're going to continue to take a look at these portfolios right through the next few years. And if you have any questions about anything you heard on the show, write to us. Our email ID is at the bottom of your screen. Tune in next week to catch the very exciting year-end New Year special, where we'll actually pick out the best funds to invest in for the coming year. So whether it's large cap, it's multi-cap, balanced or debt, we'll give you a list of funds that you can start working with in the new year. Tune in next week to catch that show. Thanks for watching.